Welcome everyone to our second Fireside chat. My name is Valerio Magliulo. I'm the co-founder of Abatable. Abatable is a carbon procurement and market intelligence platform that supports carbon underwriting and procurement for corporates and investors. Let me start by introducing our amazing panel for today. First up, we have Elizabeth Aldrich, Vice President of Business Development at Blue Source. Blue Source is the largest developer of carbon projects in North America and retailer of environmental products, including renewable electricity certificates. Thank you, Elizabeth. Next up, we have Casey Leist. Casey is a Senior Director of Carbon Finance at CarbonCure, which is a leading manufacturer of carbon removal and utilization technologies that capture carbon dioxide into concrete. Thanks for joining us, Casey. Up next, we have Lisa DeMarco, Senior Partner and CEO at Resilience, which is a climate and energy specialty law firm providing expert legal, policy, and regulatory advice in the market. Welcome, Lisa. And finally, we have Maria Filmanovic, which is my proud co-founder of Abatable, and joining us today and substituting, unfortunately, Lisa Walker, who from Ecosphere Plus, who could not join us due to a personal emergency. So before we kick off, I would like to mention this Fireside chat is being recorded, and that we'll be sharing the recording of the event with all the attendees afterwards. If you have any questions for any of our panelists or for all of us, please use the Q&A tool in Zoom, which should be just at the bottom of the tool. And we'll try to answer as many as possible towards the end. We'll leave enough time to address all the questions. So getting started, let's kick things off, just looking at the current state of the market. I think it's very easy to argue that the last 6 months have been incredibly eventful for the voluntary carbon markets. We've seen a boom in the market, predominantly driven by high expectations that carbon offsetting demand from corporate buyers is going to be increased substantially. We've seen a massive surge in net zero commitments across industries, and also various initiatives to establish frameworks and guidelines which have accelerated dramatically. We've seen a lot of experts estimating that demand will far outstrip supply over the next couple of years. A lot of sort of mentioning 2024 being the tipping point, as a lot of the companies are going to be starting to execute on their net zero commitments. We've also seen prices for carbon offsets reaching new heights off the back of a very successful COP26 in November, but we've also seen quite a significant price drop and recently caused by current energy crisis and particularly the war in Ukraine. So Maria, maybe you want to kick things off, and I think it would be useful to understand what is the perception from corporate buyers of the current state of the market, and how are they trying to adapt to this volatile environment in order to achieve their net zero goals?
Yeah, absolutely. Well, I think it's definitely a very complex market to navigate. So I think that at first, from a buyer perspective, it's probably good to empathize with them. And part of it has to do with the fact that, a lot of them approach this space and see a quality problem. Historically, they've looked at carbon registries that no longer correlate with what, for them was a quality stamp. At the same time, we see a substantial number of entrants and increasing the number of intermediaries that are looking at the space. And if I'm from the corporate perspective, it's really hard to deal with them. Often the feeling we have is that they're not transparent, and it's unclear what the relationship with developers often are. And lastly, as you've mentioned, Valerio, we've seen a substantial supply shortage, particularly for high quality credit. Corporates historically have been able to access no problem a lot of the large inventories and often at relatively cheap prices, but the supply has dried up now and prices have been very volatile. So ultimately, I think what this means is the buyers need to be looking at this because they've made a voluntary pledge by 2050, some of them ambitiously 2030, 2040 as well. And they need to be looking at procurement as part of their roadmap. The public is asking for it, the buyers are asking for it, the board as well. So what is clear is that the corporate buyers need to be a bit more sophisticated, some of which entails going a bit earlier, dealing with developers a bit earlier, and thinking about forward purchase agreements as part of that, which is the topic of today's discussion.
Awesome. And kind of related to that, I think, Lisa, it would be very helpful to understand how the existing legal and regulatory framework are suited to support all these different dynamics, right? How are organizations like AITA, so International Emission Trading Associations, doing about it, and what are the developments that we're most excited about?
Thanks very much, Valerio. And in full disclosure, I'm the chair of the International Emissions Trading Association. So of course, whatever it's doing is fabulous, but there are a number of initiatives, particularly in what was historically the voluntary market. And now I'm going to say something very controversial, but I don't think it's that controversial based on the law. We don't have a purely voluntary market anymore. As of November 13th, 2021, when we got the Article 6.2 decision, we are starting to see an increasing convergence of voluntary emission reductions and carbon credits with the Paris compliance world. And in particular, a lot of the power and decision-making as to whether or not it's voluntary or not lies in the hand of the host country. So with that regard, we are seeing a number of the initiatives that were formulated to enhance scale and speed in the voluntary market, very specifically the Task Force for Scaling the Voluntary Carbon Market, which is now the Integrity Council for the Voluntary Carbon Market, and the Voluntary Carbon Market Initiative, coming back to first principles and saying, how are we adjusting our initial business plan with where we need to go as a function of the changes in the decision-making in and around the Paris market. So those spaces are interesting. AIDA is definitely involved. They're part of the Secretariat and the ICVCM and very active throughout the value chain in really facilitating I for integrity and A for ambition throughout the value chain. So certainly we're watching a lot of the correlated decision-making that's likely to come through the intersessional negotiations and some of the specific rules in around Article 6.4 of Paris and how that correlates with the market as well. So we anticipate to see a significant increased interest from corporates in particular who want the highest level of integrity to look toward the Paris compliance markets, which converge, as I say, with the voluntary markets to find that.
Fantastic. That's a very valuable perspective. And so we're seeing how on the corporate side is a really pretty difficult market. From a regulatory perspective, there's still a lot of work to be done and sort of, as you said, a lot in the works. Moving on to the supply side of the equation. Elizabeth, one of the things that we've seen is particularly nature-based solutions have benefited from quite a sudden increase in prices post COP26. We look quite often at the NGO contract from CBL Expansive as sort of quite an established benchmark in the industry. We've seen it climb from $8 a ton to heights of $16 a ton, and only to drop again to $8 a ton. And we've seen sort of similar trends in other benchmarks. So from your perspective and Bluesource perspective, how this price volatility has changed your marketing strategy over time?
Okay, yeah, great question. Well, I will just mention Bluesource, which has recently merged with Element Markets and been acquired by the TPG Rise Climate Fund. We do focus our project development on North America only. And I mention that because, the NGO price is primarily a factor of international RED projects. And so while we have seen some volatility there, truly, we have not seen any let up on demand for North American forestry, and our prices have not tracked that NGO. We have remained quite high. There is a lot of demand. And so I only point that out because from our standpoint, there is still a shortage of supply and our markets are quite strong. There is typically a premium for North American forestry given the alternative uses of the land, the value of the timber in the markets, for example, in North America, or the value if the land were to be converted to, say, urbanization or cropland. And so for that reason, our VERs within improved forest management, avoided conversion, they still command a premium, and our markets are doing quite well. So in terms of kind of just day-to-day or month-to-month fluctuations in international prices, it doesn't necessarily affect us very significantly. And we're still seeing strong demand. So like Maria said earlier, it is probably a tactic that I think we'll see more and more corporates take, is to try to get those long-term agreements for offtake to try to hedge against rising offset prices.
Understood. And I think another interesting area that has seen quite a lot of interest and demand over the past year particularly has been more of the permanent carbon removal solution space. Their popularity in the market has increased substantially, partly driven also by some of the ambitious carbon procurement programs that companies like Stripe and Microsoft have been running quite successfully for a couple of years now. So Casey, have you seen such a surge in demand for your solutions, for what CarbonCure offers? And how has that sort of developed and changed your way of operating?
Absolutely. We've been very fortunate to see the growth that has occurred with all these climate commitments being made by the companies that as they try to reach their net zero goals has definitely been transpiring into the carbon removal category as well, particularly since Stripe's first application and procurement process for an engineered carbon removal solutions that kind of kicked everything off, which Shopify quickly followed. And we've only seen the momentum for solutions such as ours continue to grow since then. And we continue to have a number of, whether it's carbon credit buyers or other players in the space, as you touched on earlier, there's a lot of people who are coming into the space trying to help out, trying to grow the overall carbon markets holistically, and particularly trying to help these engineered carbon removal solutions get to scale and be able to drive down that cost curve and be able to get where we need to be able to get to be able to achieve the Paris climate goals.
Awesome. Thank you, Casey. And so we've touched a little bit about upon price volatility and sort of scarcity of supply, or at least sort of relative to where we see the demand right now and where we see it projected in the coming years. And so a lot of the things that we see in the market ourselves as we interact with a lot of corporate buyers is sort of an ask to how can I secure a steady supply of carbon credits so that I can have certainty that I will meet my net zero targets over time, and also have some visibility into how much it's actually going to cost me, what will be the price of achieving my net zero goals would be. And so we're seeing corporates becoming more and more aware of the need to move away from perhaps just spot purchases, and so buying whatever is available in the market today, and just moving into more forward contracts. But there's still concerns and questions that need to be answered, and we're trying to address them. And just yesterday, I think Microsoft released their new report with the lessons learned from their carbon procurement, which is really interesting to read. And one of the key lessons learned was actually corporate buyers should pursue multi-year purchase agreements and investments as well, so they can help develop the market, as Casey was saying. So Lisa, from your perspective, can you tell us a little bit about, for the uninitiated in the market, what are carbon offtake agreements? What are the main types of contracts that you see in the market? And how can these actually be supportive of forward transactions?
Thanks very much. There are two basic classifications of agreements. The first is a primary market agreement, wherein you buy from the project developer directly. And in that way, it can be a long forward purchase. It can be a spot purchase. There can be prepayments. Quite often, many of the project developers need some financing help, and they do that using the emission reduction as a form of security, where there's either partial payment or full prepayment for a discounted notional price going forward. And then that's the one classification in relation to the primary agreement. Then there are secondary agreements, which are really the subsequent sales in either the units themselves or some derivative or interest in the units themselves. And from that perspective, the contracts look quite different. One looks more like a derivative contract, and the primary contract looks like a combination of project finance and a purchase and sale agreement. So lots going on in contract development. Let me refer to AIDA. It's got an initiative out to provide some standardized contracts, both for the primary market and the secondary market. In the secondary, it's looking at some form of guarantees and a risk allocation that makes it either more or less attractive for the buyer or the seller, depending on who you are, and a standard even risk allocation. So there are many parameters that you have to look to in determining what type of deal that you'd like to do. And in particular, looking at the primary market, we're seeing much of that market move towards a steady stream forward type contract, particularly where there's certainty in the government's position. And I'm going to harp back to my first point. one of the major risks in those contracts is that the host government now has greater power, and the contracts therefore have greater stroke of the pen risk that the government might effectively nationalize or expropriate something that you think you've purchased because of the new Article 6 decisions.
Thank you, Lisa. And so that explains a lot of what is happening in the market in terms of developing standardized contracts. And obviously that's something that some of the corporate buyers that we work with are very interested in tracking and understanding when they can start using a lot of those. But perhaps from a supplier perspective, I know, Elizabeth, you mentioned that there hasn't been as much of price volatility perhaps in the North American market, which is where Blue Source operates. But I assume you're still expecting quite a substantial price increase driven by an increase in demand. And so how are you looking at forward contracts in this context? And are there any concerns from your perspective in potentially locking a specific price point today that it's harder to predict?
Great question. We are very bullish on where voluntary offset prices are going, both what might be considered avoided emissions as well as removals. So when we talk about a forward contract, we would not lock in a price. We would have an escalator applied. And so I would say there's kind of two ways that a corporate that's interested in purchasing a forward stream of offsets could look at things. They could engage in this long-term offtake agreement, and they could, they would be subjected to the escalator on those offsets. And I think it's important to note with most of those, project developers do things differently, but most project developers are going to want to engage in a long-term contract on a unit contingent basis. And that's just a really important point because there is some risk involved in future years with issuance from projects. And that could be due to, say, wind or pest or fire. If you're talking about a forestry project, there could be legislative changes in the future. So there are a number of risks that typically project developers are not willing to take on. So when we talk about unit contingent structures, it means the off-taker is going to essentially take, if they're, say, for example, the first position buyer, so they're the first buyer of a particular issuance, they would receive up to a certain quantity specified in the contract that is issued. And the project developer is only on the hook to provide what is issued to that first position buyer. Often we then have second and third and even fourth position buyers behind that one. And they would get remaining volumes from the project that were not delivered to that first position buyer. But anyway, this unit contingent structure works quite well for project developers. And then likewise, on the other side, the buyer is not on the hook to pay for anything in advance or, in later years that is not actually delivered. And so I just do bring that up because it is a typical structure. It's not always the structure used, but it is one that works well. So just in thinking about forward contracting, that's pretty standard. Another way that corporates could support a project is through an equity stake in a project. And I'll just mention that is something that is certainly interesting. It's how these markets are meant to work. And that, of course, rising prices is great because it helps stimulate more project development, which means more mitigation and more action to stabilize our climate. In that, though, I think it is important for the corporate to understand the risk associated with the project development and any risk with offset issuance, and to really also understand that they're in a competitive environment for their cost of capital, that there are a lot of entities trying to help support and finance these projects right now. And so they're going to have to be competitive with their cost of capital. So that's just a little bit about where we are in this environment for forward contracting right now.
Thank you, Lisa. And I'll put a pin in the sort of equity stake. We'll come back to that and sort of corporates going a bit earlier because it's something that I want to ravel a bit more. I don't know, Lisa, if you had anything to say a little bit about the unit contingent structure and the offtake agreements, and something that sort of you've seen, and what's your take from a regulatory and sort of from a legal perspective as well?
Yeah, I would definitely agree with Elizabeth in terms of the unit contingent structures is really the most attractive to most of the project developers. And basically, we use that as short form to say you'll get the credit if, as, and when it is produced. And in that way, you mitigate, you don't alleviate, but you mitigate some of the regulatory risk, particularly if you're dealing and working in a new field, like some of the carbon removals protocols are being developed as we speak. And so when you don't know precisely the steps you need to take to create the associated carbon dioxide removal or emission reduction or emission avoidance, it's very attractive to use an associated unit contingent approach. If a corporate has made a fixed firm commitment, sometimes they want more certainty than unit contingency. And this is where we're seeing the market shift towards equity positions and or related other activity that's a combination, a portfolio of approach, including fixed firm obligations, which are generally higher price, unit contingent long-term obligations, which have variable or indexed or escalating prices, or in certain instances, fixed prices over the course, if they're high enough, over the course of the term of the agreement. And we have other approaches where they'd go to the market. Many corporates have different reasons for pursuing a particular approach, but the one commonality for all the corporate buyers that we've acted for, continue to act for, is reputational risk. They're all extraordinarily worried and concerned and want line of sight on reputational risk that it could arise from the project itself or from the transaction itself. So these are all things to bear in mind as we go forward into the marketplace.
Thank you, Lisa. And so, Casey, kind of switching a little bit to your side of the equation. Obviously, CarbonCure provides you could say one of the most advanced CDR technology as far as scale goes today in the market. So it's been in the market for a while, but it's obviously a lot more early stage perhaps than a lot of the nature-based solutions that we've looked at and spoke about with Elizabeth. And so CarbonCure has been offering sort of more longer term purchases or forward contracts for its clients. So I'm very curious to understand from your perspective, as you are in a slightly different pricing trend, and so you expect over time to be able to reduce the cost of your technology and therefore the cost per tonnage of the credits. How do you balance that sort of need for longer term funding and early purchases with sort of the need to bring down the cost curve over time?
It's a great question. We're able to work with buyers both with spot purchases and long-term contracts, but as far as driving down the cost curve, we see the long-term offtake contracts as going hand in hand with being able to do that. When we're able to get a long-term contract, it gives us the certainty that we need to be able to go out in the market and be able to work and drive down those cost curves. Because our technology has been out in the field, we've now sold in more than 500 systems across the world. We have a lot of really good data points on what our cost is on a per ton basis and what that cost will look like as we scale it. And when we sign these long-term agreements, we've generally been leaning towards more fixed price structures just because we have pretty good visibility into what that cost will look like, particularly at the volumes that those buyers are looking for. And it's the best way to be able to get our flywheel going. The more carbon credit purchases and demand we have, the more demand we have by concrete producers to utilize our technology, the more carbon savings and carbon removal that they provide, and it kind of drives around that flywheel that we're looking to be able to achieve.
Awesome. Thank you so much. And so we touched a little bit upon sort of the risks in sort of more future offtake agreements. Lisa mentioned as well sort of counterparty risks. Maria, can you just tell us from more of a broader perspective, what are the risks that need to be considered when contracting directly with project developers? And what can sort of corporate buyers do to mitigate some of those risks?
Yeah, I mean, risk really depend on when corporate buyers are interested in coming in from a sort of project development lifetime. I'd say we've seen the corporate buyer grow as early as, being an investor, to what Elizabeth was mentioning. The level of risk you're taking there is substantial, whether it's, the quality of the counterparty, the developer themselves, the carbon implementation risk of the project design and implementation, scale up, the under delivery potential you could get from the carbon schedules being wrong at first, and then sort of iterating along the way and realizing that the carbon outcomes is substantially lower than anticipated. So it's very high risk early stage into the project development lifecycle. As you approach verification, there's verification risk, volume risk, price risk, and along the supply chain, I guess, of the project, there's substantial natural climate risk. That part of them are mitigated in the methodology through risk buffers allocation. Often through Vera, you'd be able to see a 10-20% risk allocation that is a buffer. Sometimes that's sufficient, sometimes it's not relative to extreme climatic events. And then, of course, Lisa mentioned the changes of legislation that could substantially impair your carbon rights to the project. That also being a new risk that is, of course, more prominent now in the context of the change in regulation. Where we see buyers is, historically it's been really late stage into the project development curve, contracting spot when the volumes were there. As they're moving earlier and earlier, they need to be aware of the fact that they're taking more risk, and good investment diligence, typically on the quality of the developer or the project itself, is often, a good indicator of what are the quality of the project they're going into.
Thanks. So you've given us a pretty broad stroke of a lot of risks involved. So Lisa, from a contractual perspective, how well these offtake agreements are suited to mitigate some of these risks from a legal standpoint, and what cannot be mitigated from a contractual perspective? And so corporate buyers need to rely on better due diligence and better sort of assessment of the projects and the counterparties they deal with.
Yeah, I mean, one of the key messages is that the contracts themselves are living. They evolve as we enhance and increase our experience, particularly with certain types of projects and certain types of jurisdictions. So how we're generally seeing the contracts concentrate the classifications of risk and address them. There are some that we've come a long way on, certainly in terms of counterparty risk and how you mitigate that. Some good due diligence can happen. In terms of country risk, we've got a ways to go, and we've got a new host of risks. In terms of enforcement risks, there have been some significant developments in terms of international arbitration in and around carbon-related contracts. In terms of currency risk, there are mechanisms within the market that need to be looked at, and I think that's quite significant now as we find ourselves in a geopolitical period of quite significant volatility. And in terms of the associated delivery risk elements, I think the UN system and the marketplace, the various standards themselves, are really working hard to coalesce on mechanisms to mitigate that risk. And I would look very closely to the host country related letters of authorization, whether or not it's a voluntary or Paris compliance credit, as a significant future mechanism to really tidy off whether or not you're exempt from authorization and therefore truly voluntary, and for what period of time, or whether you're covered by an authorized for use designation, either towards an NDC or towards what the decision, the 6.2 decision calls an other international mitigation purpose. And that can be CORSIA, that could be towards corporates, that could be whatever the host country says it is at this point.
And so really interesting, sort of, you talked about contracts being a living document, Lisa. And so one of the things as well that we're seeing is we're seeing a lot of comparison between offtake agreements and PPAs, especially what they've done in the renewable energy certificates market, the RECs market. So are there any parallels from a legal standpoint, contractual standpoint, that can be helpful to understand for corporate buyers who may be familiar with some of these frameworks?
There are definite parallels and there are definite differences. One of the parallels is the associated living nature of a corporate PPA, where most often you're involved or contracting at the very earliest stages of the project. And that offtake becomes part of something greater. It's not just the renewable energy certificate. Often it couldn't be a bundled power offering or a co-benefit, some ability to claim certain things. And in that regard, very analogous. Where it's different is that in a corporate PPA, everybody knows what an electron is. With carbon, the unit, the what you're selling, is precisely what your contract says you're selling. And that can be defined relative to a specific standard or relative to a host of standards or a bespoke bundle of rights. And I think one of the ramifications of the Article 6 decisions is that you're going to have to be much more precise about what is in the bundle of rights that you're purchasing and what's outside of it, particularly when it comes to claims.
Thank you, Lisa. And so moving to Elizabeth, because I know Blue Source has been pretty active in both markets for a number of years now. And so I think would be interesting to know is like, do you see history repeating itself now in the carbon markets? And are there any learnings from the REX market that would be helpful for us to predict a little bit better what's going to happen in the carbon markets in the coming years?
I think it's a really interesting parallel that you're drawing. And we have certainly had corporates come to us and say, I really want to support a project that wouldn't happen without my support or without the support of, say, a collective group of tech companies, for example. We'll all go in collectively and be the guaranteed off-taker for this project. And I just love that, because that's what happened in the renewable energy market. You saw these corporates that wanted to have the direct PPA or a VPPA in order to incentivize renewable energy that wouldn't otherwise occur. And I think it worked very well. And I would love to see more of that in carbon markets. I think the opportunity is there. I will say to date, in previous years, when we had that interest, it was often difficult to line it up with the timing of when we could get a new project started and online, because that corporate interest didn't always coincide exactly with the project opportunity. Now, going forward, as prices have increased, more and more entities are interested in pursuing carbon in terms of landowners and other project owners. And more corporates are looking to actually secure a long-term offtake agreement or equity stake or that type of thing. So I think matching the two is going to become a little bit more tenable as we move forward. And I really look forward to that. I am just so excited about where these markets are going. I've been in it a long time and we've been waiting for this. And so that would be the goal, is really to have those corporates make the difference and by their investment, make that project that wouldn't otherwise occur. And I just want to say, you know, this isn't a corporate example, but we did recently, just this last fall, close a $500 million JV with Oak Hill Advisors, and that is for acquisition of forest land that would otherwise be aggressively harvested. And instead of that, it's going to be managed for carbon. And that's going to be within the United States and Canada. And so we're so excited to be able to go out and identify those properties that would otherwise not get managed that way. And that's the whole point of these carbon markets, is to do that, and getting that corporate support in that way at the very beginning is super exciting.
Thank you. I'm very excited. We keep coming back to the sort of the point of the equity stake and the early investment. So I'll put another pin in that, because I just want to address one of the elephants in the room, which is sort of pricing. So we've obviously mentioned how much uncertainty there is around carbon pricing, especially in the context of forward contracts. And so we've seen prices go on an upward trajectory. We've seen some bumps along the road. And so a lot of what we've been asked is, how do you actually predict prices? How do you actually know what the prices are going to look like in a year's time, in 2 years' time? And so, you know, we're also seeing that there isn't enough liquidity in the market and trading history really and volumes to be able to actually predict future prices. And so we're not seeing enough good enough predictors. So I guess the question for you all, and I'll just go one by one, is like, how can we price that future delivery in the current market? So Casey, interesting to hear your perspective starting first as well.
Yeah, on our end, I think we just look at what our own cost curve is. So as I touched upon earlier, because we've been able to have our technology deployed out in the field for a number of years and now sold in more 400, 500 systems, we have a lot of data points on what that cost can look like, and we have pretty good visibility into what that cost is going to look like depending on the volumes of offtake that we have from carbon credit buyers, how we can drive down that cost curve. So we look at it from an internal perspective. What do we need it to be at in order to get our technology adopted and to be able to achieve what the buyer is looking for from a volume perspective? Beyond that, since we've also been in the field for a number of years, we're able to get our methodology developed through Vera. And so that quantifies how we're going to calculate the exact tons that we're delivering to buyers. So we always have that methodology referenced within the contract. And then as Elizabeth and Lisa have touched upon, there's a number of different structures for these long-term offtake agreements that you could do. I think we always want to take into account, what are buyers looking for? One of the things that we've tried to do on CarbonCure's side is payment at delivery. So not requiring prepayment for these carbon credits, so that significantly de-risk what the buyer is looking for. And then because we have good visibility into what our cost curve is, we feel very comfortable that we can fulfill those volumes that buyer is looking for, while also de-risking it from their perspective as far as the fact that they haven't come out of pocket until that carbon credit is delivered, and we know exactly how it's going to end up being quantified through that methodology. So we try to balance it from an internal perspective, kind of what do we need it to be at in order to reach our internal goals for our mission, as well as what the buyers are looking for, and then as well as what is that buyer looking for from a contractual perspective to be able to achieve their goals. And Lisa and Elizabeth touched on something that's, I think, been really exciting to market, is just in these consortiums of buyers getting together to be able to aggregate kind of that demand and be able to maximize that impact. And that's, we've seen more and more of that. And I think that's going to be a significant catalyzer to the market and the growth here.
Thank you, Casey. Elizabeth, same question to you. How can we price future delivery in the current market? You said you're very,
we are very bullish.
You're very bullish on the market.
That's true.
I'm very curious to hear how you operationalize the bull.
Right. I can't give specifics about what our future price curves are or what escalators we're applying currently, but I would say that we are very excited about where these prices are going, again, because it's going to incentivize more project development. It's going to get on the radar of landowners. It's going to help smaller projects that otherwise couldn't afford to pursue carbon finance. It's going to allow them to get into the marketplace. When we do consider what the future price will be, there are certainly considerations of the project cost. And for example, and I mention forestry often, we work with 20 different technology types for offset generation, but we do have a portfolio of currently almost 90 improved forest management and avoided conversion projects within the US and Canada. So that is the bulk of our portfolio at this point. We also have regenerative ag coming online in 2023. So a lot of land-based projects. So when we work with landowners, they often do have a floor price beyond which they won't sell. And so that does help us determine what those prices have to be, and then adding on project costs to that. They also are watching these markets very closely, and oftentimes they know the prices are going up. And so they will only commit to a project if there is an escalator applied. And so they expect that return. And so that in part does drive pricing for us. But we also are, we're watching very carefully what supply is available. And I'll just say that I think most people on the line probably know this, takes several years for a project to get developed from start to finish. 2 years is a very fast timeline for carbon offset to get issued from no project in existence to issued credit. So while we see that there will be a shortage of supply based on, say, SBTI net zero goals or other carbon neutrality goals, it's going to be years before the market can catch up to that demand. So in the interim, we realize that there will be a shortage. And even in latter years, it's difficult to say what the future will bring and whether or not we can ramp up to meet that demand. And so I will say, it used to be that people look towards forward contracts as a way to get discounted pricing by committing. And that is certainly not the case anymore, that there is certainly an escalator applied, and be prepared to have that be a very bullish escalator. But that still is a very important part of financing projects, making sure they move forward and providing that certainty to the landowners and other owners of the project so that they can move forward with the project.
Yeah, I completely agree. Also, from our perspective, we're seeing a lot of the shift from sort of that discounted approach that you mentioned towards something that is giving more certainty, at least, or more visibility rather than necessarily a discount. So that's something that we're seeing actively in the market. So Maria, a question to you as well. I know the answer from our perspective internally, but obviously for the benefit of everyone in the audience.
Yeah, I would say, I mean, Casey and Elizabeth touched on it. It's very important to have a sense of what development cost is for different project types. And all the different project types, even within nature-based, can be very, very different. If you think about forest conservation, often the capital required to be managing a project and developing that could be substantially lower relative to an agroforestry project, for example, and you need to acquire the land, need to operate it. And so often there is a deviation of development costs, and the risk I see is often when we have these benchmarks of reference, they don't necessarily reflect what the real development cost is. And so some developers we've seen have actually not looked to adopt the benchmark, but rather stick to what the development cost is plus a premium. And in the case where there's a substantial diversion from a development cost being substantially lower relative to what the market price is, we often encourage buyers to start asking the question of where the delta is going. How has it been split between the developer, the intermediary, the project communities on the ground? So there's a lot of questions, and what is important is always to have in mind what the development cost is of these projects. And we have visibility into the data from our side, and it's something that we look at and reference very often.
If I can just jump in for a quick second, one of the trends that we saw leading up to the 2008 global financial crisis in the carbon market specific was indexed pricing, where people would index to market. And I had I don't know if it's honor or curse of working on one of the restructuring elements of a global carbon company that didn't make it. And had a number of these indexed contracts. And while it seems very appealing and attractive to go with an indexed structure up front, on the hindsight, if you're ever in a position where you have to restructure or work out those contracts, quantification of damages can be extremely, extremely difficult. So, pros and cons to any pricing approach, but I definitely leave it to the commercial folks to get in the nitty-gritty.
Thank you, Lisa. No, much appreciated. And I think moving away now from the pricing and just into a final question, and something that has been touched upon throughout the conversation today, which was sort of how do we take a step further, rather earlier, into financing projects, getting involved in carbon project development earlier and earlier on. And so it's been mentioned, a few corporates have launched joint ventures and partnerships directly project developers to sort of co-invest in new project development. So Elizabeth, you've mentioned that quite a few times, and we know that you're probably you're likely the largest developer in North America, and so you've probably received a lot of interest from corporates on new project development. What do you look for in corporates to start a partnership with them?
Yeah, that's a good question. I will say we're in early days of that. Really, like I said before, it had been difficult to time up the corporate demand with the beginning of the project development. I would anticipate that we would see more and more. Last week alone, I had 3 corporates ask me about having an equity stake in projects. So I am very encouraged by that. Also, I do just want to reiterate that sometimes there can be a mismatch of what the corporate thinks their cost of capital is worth, given that they are in a competitive landscape for financing these projects. So I think that's important to recognize. I also think it's important for corporates to be aware of the risk that they are taking on, that Maria very eloquently pointed out, the risk of the project development, regulatory risk, that various things could happen and that the credits could not be issued. Now, having said that, we have a great track record of when we take on a project and have an estimation of VERs that'll be generated, actually producing those and delivering to buyers that have engaged in forward contracts with us. But having said that, there are risks that that corporate would need to be comfortable with taking on in order to begin to do that. And I'll just say also with regards to transparency about the percentage that, say, a project developer takes in order to develop the project start to finish, that basically can be a black box for a lot of people, but just simply to simplify it, that means the feasibility study, from the very beginning, identifying the opportunity, doing a feasibility study, getting the project owner on board, in some cases, making sure that any kind of construction occurs to create the project, and then submitting calculations to a third-party verifier, going on site with the verifier, going through Q&A with the verifier, going through the standards body review of that project, and then the credits are ultimately issued at the end of the day. That's a long process that takes multiple years. Most project developers take that on without hourly fees, but working at an at-risk basis. But we have seen that some intermediaries will even double the price that the project developer takes in order to retail those credits. And so I'll just say, with regards to transparency about project development costs on the project developer, carbon project developer side, it's also really important that intermediaries have some transparency about any kind of markup that they're charging as well. Because we know in these markets, the credits can be transferred an infinite number of times, and that leaves a lot of intermediary cost. And we really want to see the bulk of the revenue going back to that project owner so that we can incentivize more project development. So just think that's really important as corporates are scrutinizing which projects to be a part of. The closer they can be to the on-the-ground project development, typically the lower the cost of intermediaries. And then that means more money going back to that project.
That's fantastic. And so, Maria, actually, I'm very curious to hear your perspective on this. And so when looking at corporates that can want to engage in earlier into carbon project development, what are the right ways to do it? When and why should they consider doing it in the first place?
Yeah, I think it's a no-brainer for a corporate, especially in the context of, wanting their capital to be catalytic and additional. Like, what is like no best way than going direct. The only thing is there's probably very few corporates that have the balance sheet and the mandate to be able to do very early stage. And part of it is, as Elizabeth mentioned, the carbon development curve can be long until you have that first issuance. So it would need to be very well capitalized companies that can sit with that risk exposure, that they have the right expertise in-house to be able to assess, the quality of the project developer and their operating background. And I don't think a lot of corporates can be doing that, especially the ones that might have lower emission profile and might need procurement needs that are smaller. And so what is interesting is, I think, this idea of bringing them together. The other thing about the corporate being an equity investor, it's never the only investor. It's often with a balance sheet that is financially motivated as well. And I think there comes the question of how to think about maximization of value. Most corporates would want to have access to the credits. And it's important to understand how the value is set so that, developer benefits on it. They're not really just squeezed to secure a very low price for the purpose of having a corporate balance sheet. And, if the developers have a good track record, often they're very well capitalized. They can sit with that exposure and come to a point where the corporate, comes in slightly later on, and they can be the off-taker. In that case, the intermediary is taken out of the picture. And our hope is that intermediaries are going to be less and less active in this space if corporates can have the mandate and the willingness and the risk appetite to go earlier. And equally, the very large developer can be well capitalized and sit through that risk early stage.
Fantastic. And I think this is very focused, I guess, on perhaps the nature-based front of the market. And so perhaps, Casey, if you want to bring us the perspective more on the carbon dioxide removal technology side, and sort of we've seen an increasing trend and interest perhaps from corporates in what's called insetting. And so ways to bring carbon capture and storage solutions onto their facilities and reducing emission at source. So have you seen a sort of a rise in interest as well through CarbonCure? And how do you position yourself as a trusted partner with some of these corporates?
Absolutely. Yeah. The overall growth in the space that we've seen has also, we've seen that within the broader building sector. So embodied carbon is one of the largest sources of emissions for many companies, effectively any corporate entity that has its own buildings or is developing new headquarters or whatever it may be. And concrete is one of the largest sources of embodied carbon. So we have a number of corporates who have reached out to us to try to help them reduce their carbon footprint within their own value chain, such as Amazon for HQ2 that just got built. They use CarbonCure's technologies within that. One of the benefits we've had since we're a little bit further along is with our Vera methodology, there's a clear, specific way on how we quantify what that impact is. And since we're working directly with the concrete producers, and we have telemetry and we have complete visibility into the traceability of the CO2 molecule from the point of capture all the way to the injection at the concrete producer, we can quantify specifically what that benefit is that we're delivering. And then the Vera methodology backs that up and has some of the discount factors and so forth that apply within that to make sure that it's scientifically rigorous. So we've seen a lot of growth within it. And we have a team specifically that is dedicated to working with end users or building developers to be able to get them educated that there is green or low carbon concrete out there, and CarbonCure can be a solution to help you reduce your emissions within your own value chain, as well as buyers who are looking for offsets who can't do that within their own value chain.
Awesome. And I think we actually have some questions related to that. So I think it's a great way for us to now jump into the Q&A. Conscious of time, I've got loads of really interesting questions. But thank you very much for all the contributions so far. I think we've covered quite a lot of grounds. It's been certainly engaging from my perspective. So I think the first question, Lisa, perhaps would be helpful for you to take on is, in Article 6.4, can governments take hold of existing projects that have been running for many years or only new ones?
The Article 6 decisions apply from 2021 onwards is the wording in the decision. But in terms of transferring an Article 6.4 project internationally, it has to be done through 6.2. So the Article 6.4 credits, when transferred internationally, become internationally transferable mitigation outcomes, or ITMOs. And in that regard, there is particular risk because there's host country authority and agency to change. And we're seeing this in a couple countries right now. There were a number of voluntary transactions that were in the process of delivering tons, and the Indonesian government put an effective moratorium on the transfer while it is figuring out how it will, in particular, from the corporate purchaser standpoint.
I think we're losing Liz a little bit.
In the country correspond to the transfer of those tons going out of the country, whether in fact there is a corresponding adjustment or not, and that the accounting lines up. The last thing any well-meaning corporate wants is to find out 2 years down the road that its ton has been used 2, 3, 4 times.
Thank you, Lisa. I think we have another question sort of related to the price escalator that you've mentioned, Elizabeth. So in a forward purchase that includes a price escalator, is it also customary to include a most favored nation clause? So that can protect buyers for overpaying for future vintages?
That is not customary in my experience to date. I will say, Lisa mentioned this, but there is this possibility of using indexed pricing into the future if there's concern over overpaying. And you can do that with a price collar so that the buyer can be assured that they're not going to be overpaying well beyond market. But it sounds like there are some complexities with exiting those. So that was good information for me, but that is something that we have done in the past that could be interesting. Provided you have provisions for an out in the case of the need for that Lisa told us about.
Casey, we've got quite a lot of questions for you and just trying to go through all of them, but I think that this is an interesting one. So beyond Stripe and Microsoft's ability to rely on balance sheet to do great things, what is the economic incentive for other corporates to buy offtake agreements for your credits, which should reduce in price over time?
I think this is whatever goals they have made internally from a sustainability and climate perspective, we can help them in achieving that. So whether that's building developers who are looking to decrease their scope 3 emissions, who are developing buildings and using concrete, or offset buyers, but there could be a number of ways a number of reasons buyers may do that. They may have a net zero goal, and this allows them to be able to meet that, to different initiatives that they have, whether it's employees who are providing a lot of feedback to the companies that they work for, that they want to see them doing more in the climate space. And then there's been a number of founders and I think leading CEOs who just want to have their companies being leaders within helping address climate change, because they think that their company can go above and beyond what their actual technology or what it is that they're responsible for.
Thanks, Casey. I think we have time for one or perhaps two last questions. Oh, we dropped Lisa. Oh, Lisa. Perfect. I had a question for you. So what, in your opinion, are the factors that may cause a forward contract to be viewed as an investment contract or as a future?
This is a very good question. That is a very long and detailed answer, depending on the facts. But one of the relevant elements is that you're either falling within a very defined form of an exempt commodity contract, particularly in the US, let me speak to. And I'm a Canadian lawyer, so I'm not saying that based on a US legal opinion. I'm also a UK lawyer. If you're selling in a physically delivered commodity, safe to say that the regulatory requirements are far less than if you're falling within the realm of a security. And many investment contracts may in fact fall within the realm of a security. So in choosing those upstream equity investment pathways, you have to consider this issue very carefully. What are the downstream securities regulatory risks and delivery risks? And there are in fact a number of times when the answers to those questions shape how we draft the contract. Great question. Very good question.
Yeah, there's a lot of great questions, but unfortunately we've come out of time. And so I think we're going to follow up by email with a lot of these questions, so just to make sure that they get answered, because there's a lot of good stuff in here. So thank you everyone for attending our second Fireside Chat today. We were joined today by some leading experts from Bluesource, from Resilient, from CarbonCure, and from ourselves, Abatable. We've heard different perspectives and insight into both the supply side and the demand side of the market. Absolutely feel free to get in touch with any of the panelists, reach out by LinkedIn if you have any follow-up questions that will not be answered. And also feel free to reach out to us if we can help you navigate the volatility in the carbon markets that we've been speaking about. Thank you, and thanks to all panelists.